Welcome to Sophie Daddy's channel. Today, we're diving into a really fascinating puzzle that sits right at the corner of high finance and artificial intelligence. I mean, we have AI that can master the most complex games on Earth. It can create incredible art. So why can't it just solve the stock market? It's a question that really gets to the heart of what AI can, and maybe more importantly, what it can't do. Seriously, it's a fair question, right? With all this amazing predictive tech, you'd think cracking Wall Street would be a done deal by now. But the truth is, it's just so much more complicated than that. And the reason has nothing to do with a lack of computing power or not having a clever enough algorithm. The answer, the key to this entire explainer, really just boils down to one single, powerful word. Assumptions. Every single machine learning model, I don't care how fancy it is built on a foundation of assumptions. It has to believe certain things about the data and the world in order to even function. You can think of an AI model like a giant skyscraper. Its predictions might look incredibly impressive from the outside, but if the foundation, its core assumptions, is built on shaky ground, the whole thing is just doomed to collapse. And in the world of finance, the ground is basically a constant earthquake. So, what makes the financial market so incredibly hostile for AI? Well, it's because the market systematically and constantly breaks the core statistical rules that most machine learning models just take for granted. We're going to walk through the 4 biggest broken rules that every single quantitative analyst, or quant, has to deal with every single day. First up is a big one, non-stationarity. Okay, think about it like this. If you're training an AI to recognize images, a cat is always a cat. The core features of catness are stable over time. But in finance, the statistical properties of a stock's price, its average value, its volatility, they're always shifting. The rules of the game that worked in 2019 are totally different from the rules we have here in 2024. So trying to directly predict a non-stationary price is just a recipe for disaster. Your model ends up finding all these fake relationships just because 2 completely unrelated things were happening to trend up at the same time. So what do quants do? They adapt. They get clever. They change the question. Instead of asking, what will the price be? They ask, what will the change in price be? By focusing on predicting returns, they turn a wildly unstable problem into something way more manageable.
All right, the second broken rule is something you've probably felt deep in your bones if you've ever watched the market: volatility clustering. All this means is that calm, quiet periods in the market tend to be followed by more calm. And chaotic, high volatility periods are followed by, you guessed it, more chaos. The market's risk level isn't some constant flat line. It moves in waves.
And this is so important, because if your model just assumes risk as a flat, unchanging number, it is going to fail at the absolute worst possible moments. It'll take on way too much risk right before a crash, and then it'll be way too cautious during a stable growth period. It's kind of like trying to use the same light jacket for both a sunny afternoon and a Category 5 hurricane.
The third broken rule is what we call low autocorrelation in returns. Now, thanks to something called the efficient market hypothesis, any simple, obvious pattern, like, hey, if a stock went up yesterday, it'll probably go up today, gets noticed by thousands and thousands of traders. They all jump on it instantly, and in doing so, they make the pattern vanish. It gets arbitraged away, which is just a fancy way of saying the easy money is gone before your AI can even find it. And this creates the absolute core problem in all of quantitative finance, an incredibly low signal-to-noise ratio. The actual predictive signal you're looking for is like a tiny whisper in the middle of a hurricane of random market noise. This makes it dangerously easy for a powerful AI to overfit, which is where it doesn't learn the whisper of the real signal, but instead it perfectly memorizes the roar of all the random noise from its training data. And the final broken rule is maybe the most terrifying of all: fat tails. You see, if you chart out market returns on a graph, they don't form a nice, gentle bell curve like so many statistical models assume they do. The tails of the distribution are much fatter. This means that extreme events, those black swans like massive market crashes or huge sudden spikes, happen far, far more often than a normal distribution would ever lead you to believe.
And that's the real killer. A model that assumes the market is normal is fundamentally broken from the start. It will systematically underestimate the probability of a huge loss, leaving a portfolio completely exposed. It's a risk management system that works perfectly, except during the exact moments you actually need it to protect you.
Okay, so we've established the market is basically a minefield of broken assumptions. How do quants even try to navigate this?
Well, they do it by being really, really careful about choosing their tools. So let's look at the main types of AI models as if they were different contenders, or fighters, each with their own unique style and a critical weakness. First up in the ring, we have tree-based models, like random forests. You can think of these as superpowered detectives. They are brilliant at sifting through data and finding complex conditional rules, like if interest rates are low and a stock's valuation is cheap, then it tends to go up. They are absolutely fantastic at interpolating, at finding patterns within the range of data they've already been trained on. And a huge plus, you can actually look inside and understand their logic. But they have a fatal flaw. They cannot extrapolate. A tree model cannot predict a price of $121 if the highest price it ever saw in its training data was $120. This makes them great for strategies where patterns repeat, but totally useless for predicting new breakout trends. Next up, we have the heavyweight champion of hype, the neural network. Thanks to a really cool piece of math called the universal approximation theorem, these models are, in theory, capable of learning pretty much any continuous function you can imagine. They're incredibly powerful and just unbelievably flexible.
But all that power is a massive double-edged sword. In the low signal-to-noise world of the market, that flexibility makes them extremely likely to overfit all that random noise we talked about. And, crucially, they assume the relationships they learn are stable. So when the market regime shifts, say, from a bull market to a bear market, the rules of the game change, and that once brilliant neural network can become worse than useless overnight.
Our final fighter is the LSTM, which stands for Long Short-Term Memory Network. Now, this is a special kind of neural network that was designed from the ground up to understand sequences and time. It has a kind of memory built into it that lets it recognize patterns that unfold over very long periods. But here is the subtle, hidden assumption that trips people up. An LSTM can handle a trending price, no problem, but it has to assume that the dynamics, the fundamental physics of how that trend works, are stable. If the underlying market behavior itself changes, its sophisticated memory isn't going to save it. The rules of memory themselves have to be consistent for it to work. So you can see the trade-offs right there. You've got the easy-to-understand detective that can't spot new trends. You've got the all-powerful approximator that might just be learning garbage. Or you have the memory specialist that can be fooled when the market itself changes its behavior. The key takeaway is this: there is no single perfect model. And that brings us to our final and honestly our most important section. If every single model has a fatal flaw, and the market is constantly breaking all the rules, where does the real skill lie? It's not in building the most complicated algorithm. It's in what we can call the art of managing assumptions. This is the hierarchy, the way a real quant actually thinks. You see, it doesn't start with the AI. It starts with a human hypothesis about the market, a belief about some kind of inefficiency or pattern. Only after that do they choose a model whose own assumptions line up with that belief. And finally, they transform the raw data to build a bridge between the messy reality of the market and the clean world the model needs to see. And this quote just says it all. This isn't about finding some magic black box that spits out money. The whole game, the entire process, is an exercise in assumption management. The quant's real job is to choose the right set of lies, the right set of simplifying assumptions that happen to be useful for a specific task, for a specific period of time, before the market inevitably changes the rules on them all over again. So let's end with this thought. The next time you see a headline or you hear someone talking about a groundbreaking new AI that has solved trading, you'll now know the first and the most important question you need to ask. And it's not how complex is your algorithm or how much data did you use.
The right question is, what are its assumptions? What does this model assume is true about the world in order to work? Because in the chaotic, ever-changing universe of finance, that foundation is absolutely everything.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, Well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.